In this video, we're going to be looking at basic transactions when money is going out of the business. So let's start with this example here. On June 4, we paid rent, which cost us $600. So two accounts affected here. The first account that's going to be affected is our cash at bank because we're paying rent. So our cash at bank is going to go down. The other account affected is this rent expense. So under expenses, we're going to have down here our rent account. So they're the two accounts affected. Let's now fill out our transaction table. On June 4, one account affected is our cash at bank. I'm going to call that our CAB. Type of account, that's an asset account. Nature of assets, they're debit by nature. This time, because we're paying money, our bank account's going down because we're paying an expense. So that's going to flip from a debit to a credit, and the amount is $600. Our new account is rent or rent expense. Rent expense down here is an expense account. I'm just going to put an E. The nature of expense accounts, they're debits. Our expense account has gone up. So it was $0, it's now $600 because we paid $600 rent. So that stays the same. A debit for $600. Let's look at our next transaction. We purchased a new motor vehicle for $20,000 on credit. Sorry, somebody's biting me. This is my new little puppy. Say hello. His name's Boomer. He's 7 weeks old and he keeps biting me. Say hello. He's really cute. Sorry, so we purchased a new motor vehicle for $20,000 on credit. Two accounts are affected here. The first account affected is our cash at bank. Actually, no, it's not, because we didn't actually buy this motor vehicle. We bought it on credit. So our two accounts affected are going to be our motor vehicle account, which is an asset. So if I look down here, motor vehicles, our other account that's going to be affected is accounts payable, which is a liability because we're not actually paying for this motor vehicle, we're buying it on credit. So they're the two accounts affected. Let's now fill out this table. We are not given a date. I'm just going to call it June 1. First account affected was our motor vehicle account. Motor vehicle is an asset account. We know our asset accounts are debit by nature. Our motor vehicle account has gone up by $20,000, so it stays a debit for $20,000. Our other account affected is our accounts payable. Now, accounts payable, if we have a look over here, is a liability. If we have a look at our accounting rules, liabilities are credit by nature. This has increased. We now owe $20,000. So this is going to stay as a credit for $20,000. This transaction on June 8, we paid $500 off P. John's account. So we owed P. John's a certain amount of money and we paid $500 off that. So the two accounts affected here. Firstly, we're going to have our cash at bank affected because we've paid a certain amount of money, $500. The other account affected is our accounts payable. So accounts payable, we've reduced the amount of money we owe to P. John's. So let's have a look at this in our table. The date is June 8. Our first account affected is our cash at bank. Cash at bank is an asset, which is a debit by nature. We've paid $500, so that's actually decreased. So that will flick around to a credit for $500. The next account affected was our accounts payable. Now, accounts payable, if we have a look at our chart of accounts, is a liability account. Liability accounts, we know, are credit by nature. Now, what's happened here? Has it increased or decreased? If we've paid off $500 off our balance, that's actually decreased. So when something decreases, when a liability decreases, it flips around. So that's actually going to flip around to a debit of $500. You can see here our credits equal our debits.